Hello traders, Gary Wagner here, just before 10:30 in Honolulu, 4:30 in New York. It is Wednesday, 5th day of April, 2017, and this is the Daily Report for Gold and Silver. What a whipsaw market we have seen, with pivotal key reversals occurring once we had a knee-jerk reaction to a couple of pieces of fundamental data that came out. The Fed minutes were released, of course, and ADP's job numbers, which came in far, far above initial estimates. Now, we had gold, silver, precious metals complex as a whole under pretty dramatic pressure immediately following the release of this morning's jobs report, as well as the Fed minutes, actually taking us to a low of about $12.45 intraday, down about $10 or $11 if I recall. As the market came up, and we'll talk about this, of course, in detail when we pull up our first chart, I actually did issue a trade alert, sent that out by SMS message as well as email. For those that pulled profits last week at 1247, as I said over the last couple of days, we've been waiting for a dip to enter the market. We got that dip today. Traders taking the call got in at 1250. Those who were in from 1237 are still in. All stops for all subscribers are back to being 1239, and we're all 100% allocated back in the market, I'm happy to say. Gold closing in essence unchanged. It was trading slightly higher with a high of about 1259.30 and closed at 1257.80, which, as I said, is fractionally lower on the day. When we look at spot gold, 1255.80, that is showing a positive net change nonetheless. Silver wasn't taking it as hard on the chin, so to speak, as this market came down. It is also fractionally unchanged, back at about 1830, with spot silver trading at 1828. So to say that today we saw some volatility in the market would be an absolute understatement. The first chart that we're looking at is a very short-term standard candlestick chart, with each candlestick representing 60 minutes or 1 hour in time. We can see the sideways trading activity roughly at about 1258 as we were going into the open of the session in New York. As the market opened up and news became available, the jobs report that came in much better than estimated, and then later the Fed minutes, we had this initial knee-jerk reaction in which we saw this market go dramatically lower, trading to a low really of about 1245. Now, this, of course, is June futures contract. It is now the most active. As this market came down and I noticed it coming back up, it was actually this candle, and if you refer to the chart that I sent out with the special trade alert, this is precisely where we were. I saw that we had some real support, it seemed, that entered into the market. Then secondly, and you'll be able to see this in much more detail, we did find support at a 23% retracement, which was roughly at about 1246, and I did issue a trade alert. As I said, traders taking that call got in roughly at 1250. You were in somewhere in this area, and all stops are below the lows that exist at 1239. All traders at this point are long. All traders have stops currently below 1239. What I've done is compress the chart to a 240-minute chart. So we're looking at each candlestick representing 4 hours in time. I've slowed it down, but for those of you that have been with me for a while, you know this is extremely short-term charts for me to look at. And here's one of the factors that really triggered the buy signal. I was looking for a dip, but the fact of the matter is when the market traded to a 23% retracement, and this is a very, very short-term retracement because we are only looking at some recent activity starting at about March 11th or 12th, when the market bottomed at 1200. From there, it traded to 1262, and then subsequently our 23% retracement. So when I saw the market drop dramatically, move below that point, but then start to trade back up, it made me believe that we had that initial knee-jerk reaction. That knee-jerk reaction had concluded, and most importantly, I saw the market beginning to move back up. Traders, obviously, maintain your current long position, whether you're long at 37 or 50, and traders maintain your current stop. Even though we saw an extremely resilient recovery with the gold market, trading from down 10 to back unchanged and fractionally lower at this point, there is a caveat. And the caveat is we still have not, on a closing basis, traded above this high, which is the high for this year, which resides roughly at 1265. The other thing about this number that is quite interesting is if you notice we have two moving averages. I've got the shorter term 50-day moving average, and then this lighter blue one is the longer term 200-day moving average. It is interesting how eloquently this top here and this top here line up just under the 200-day moving average. Of course, many analysts believe that a move above this would signal a fairly major breakout because going above a 200-day moving average is extremely significant. In other news in the market, an amazing turnaround by U.S. equities. As I was preparing to do the report before I went to my charts and actually started doing some research, the Dow was trading up about 130 to 160 points. I then looked at it once the markets had closed, and lo and behold, we were trading off by about 41 points, 20,648. 0.2% to the downside, and that's after trading to a high of 20,887. So we had well over a 200-point swing today in the markets. S&P also trading nominally lower, although they're off about 0.3%, and the Nasdaq down 0.6%. We do have a pretty severe turnaround in the dollar, 100.35 after trading to a high of almost 101. The low today is 130, so we're just near the lows of the day, and we do have the dollar once again coming under pressure. Lastly, crude oil, which has really been on fire since trading off of those lows at 47, is now still above $50, but now has broken back below the $51 at high that we saw yesterday. What a dynamic day in U.S. equities. Equities turning around on a dime. As I said, trading up 135 to 160 points higher to actually close down 40 points on the day. Now, we are looking at a daily chart of the Dow Jones Industrial Average. And what is interesting is it is almost the opposite of gold in that gold had an issue trading above the 200-day moving average. Look at the distance between the 200-day moving average and the 50-day moving average, and the fact that the market, meaning equities, are still trading above that. As long as we can maintain ourselves above this 50-day moving average, we could see this market trade sideways for a while, but without it breaking through this, we're not getting any kind of key reversal signal or the potential, I believe, for a downside correction. Of course, all bets are off if the market breaks below the 50-day moving average. Another interesting market that had that pivotal or key reversal is the dollar index. We're looking at that now. It's almost the mirror opposite of what we saw in gold. In gold, we had a basic, what's called a gravestone or Tombow doji. If you can disregard these points at the end, this is how it looks. In other words, there's an extremely long body from the open and close, which is a line, to the low of the day. This is the opposite of that. It's almost like a shooting star, except, of course, there is no body size to this candle. But nonetheless, a key reversal. We now see some real pressure in the dollar, and I believe that the dollar could at least track to 100 with major support not coming in till the 200-day moving average, which sits roughly at 99. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review.